Wars are remembered for battles. They are remembered for generals. They are remembered for borders changing. But wars survive on something else. They survive on money. Without money, wars stop quickly. With money, they continue quietly. This is the story of how emergency war loans became permanent power, and how temporary solutions turned into central banks. At first, this looks like financial history. In reality, it explains modern control. Early modern wars were expensive, much more expensive than medieval wars. Armies grew larger, weapons became industrial. Supply lines stretched across regions, kings faced a new problem. Victory required cash, constantly. Taxes were not enough. They were slow, they caused unrest. So rulers borrowed, not once, again and again. War loans were supposed to be temporary. They were meant to solve emergencies. They were not designed to last. But emergencies never ended. In the 17th century, European states were almost always at war. Conflicts overlapped. Peace was brief. Each war created debt. Each debt demanded structure. Each structure demanded trust. Private financiers stepped in, merchants, banking families, credit networks. They funded armies, they paid suppliers, they advanced money before taxes arrived. In return, they demanded guarantees. Future revenue, trade privileges, political access. At first, this relationship felt simple. Borrow, fight, repay. But repayment rarely happened on time. New loans covered old ones. Interest accumulated. Debt stopped being temporary. It became permanent. This changed behavior. Governments could no longer afford instability. Default meant collapse. Credit was survival. To protect borrowing, states began to formalize finance. Ad hoc loans were risky, systems were safer. This is where institutions began to form. War forced organization. Organization demanded standardization. Standardization created authority. Governments started issuing long-term bonds. Not short emergency loans. Long commitments. These bonds needed buyers. And buyers needed confidence. Confidence required rules, predictability, oversight. This pressure gave birth to early public banking institutions. They were not created to manage prosperity. They were created to manage war. The earliest central bank-like entities had one purpose: make borrowing reliable. They centralized debt issuance, they standardized repayment schedules, they reassured lenders. War loans were no longer personal promises by kings, they became state obligations. This shift was subtle, but decisive. Once debt was institutionalized, power shifted. Rulers lost flexibility. Institutions gained permanence, a king could die, a government could fall. The debt remained. Centralized banks became guardians of state credit. Not rulers, but enablers. They did not command armies. They decided if armies could be paid, their influence grew quietly. During wars, these institutions expanded. They managed bond sales. They stabilized currencies. They coordinated payments. Peace did not reduce their role. Debt still needed management. Interest still needed servicing. Temporary war finance became permanent financial architecture. This is the key transition. War created debt. Debt required institutions. Institutions survived peace. Over time, these banks gained new responsibilities: currency management, payment systems, financial stability. But their foundation remained the same: protect state credit. This also changed how wars were fought. Once states could borrow reliably, wars lasted longer. Defeat did not immediately end conflict. Credit could bridge losses. Military strategy adapted. Campaigns were planned around financing cycles, not just battlefield conditions. War became a test of endurance, not courage. Whoever could borrow longer survived longer. Central banks were not neutral observers. They were embedded in the system. Their success depended on state survival. State survival depended on borrowing. This alignment created mutual dependence. The system rewarded stability, not peace. Predictable conflict was manageable. Unpredictable collapse was dangerous. This explains why wars often escalated slowly, why compromises were delayed, why debt kept growing. The financial system was optimized for continuity. Over time, governments learned to rely on this structure. Budgets assumed debt. Wars assumed financing. Emergency became normal. Central banks evolved. They gained independence, at least on paper, but their core function did not change. Preserve confidence in the system, confidence in repayment, confidence in currency, confidence in order. This confidence allowed governments to act decisively, but it also limited them. Once markets lost confidence, options disappeared. Interest rose. Borrowing tightened. Policy followed finance. This pattern repeated across centuries, different countries, same logic. War created debt. Debt created banks. Banks shaped policy. The visible story was political. The invisible story was financial. This system also shaped public perception. Citizens saw wars as moral struggles. Financial mechanisms remained hidden. Taxes rose quietly. Inflation absorbed costs. Debt was abstract. The real price was delayed, spread across generations. Central banks did not start wars, but they made them sustainable. They turned short crises into long processes. Over time, this financial architecture extended beyond war. It managed recessions, it stabilized markets, but its origin was never erased. Every major expansion of central banking followed crisis, and most crises were tied to conflict. This is not coincidence. Systems built under pressure rarely disappear. They adapt. Today, central banks appear technical, neutral, independent. But their DNA was shaped by war finance. They exist to prevent collapse, not to prevent conflict. Understanding this reframes history. Wars were not only fought for territory, they were fought within financial constraints, and those constraints were shaped by institutions born from war. History does not repeat exactly, but incentives remain. When survival depends on borrowing, those who control borrowing shape outcomes. Quietly, structurally, permanently. From war loans to central banks, the path was not planned. It was forced, and once built, it never truly reversed.